One of the most common questions I get is how would I start a dividend portfolio, and if I could do a video for total beginners. In this video, I will go over a lot of beginner recommendations as well as what stocks I would invest in if I were starting today. That said, I would never buy a stock because someone else is doing it or claiming to be doing it. You should always conduct your own research and consider your own risk tolerances, goals, financial condition, market knowledge, and other factors. So remember, this is not financial advice. So for today's video, I will show you how will I begin with my dividend portfolio in 2022. But first, if this is your first visit to the Smart Stocks Academy channel, let me welcome you. To be the first to know when a new video like this is released, hit the like button, subscribe, and click the notification bell next to it. Now let's get to the video. So, what is the best way to begin a dividend portfolio? The first thing I do is look at a brokerage to buy stocks from. Brokerages are simply companies that assist you in buying and selling stocks in public corporations, acting as a helpful middleman. There are numerous brokerage firms from which to choose from. So, what would I look in a brokerage if I wanted to start investing today and had never done so before? In no particular order, I'd like number 1, a name I was familiar with. Number 2, trades in stocks for free. Number 3, opportunity to purchase fractional shares. Number 4, capabilities of DRIP. Number 5, accounts for retirement. Number 6, accounts in custody. Number 7, a nice mobile app and a solid online interface for the desktop. Number 8, a past devoid of major issues. Number 9, excellent human customer service. Number 10, excellent safety. And number 11, deals that are completed quickly and at the greatest possible pricing. Please allow me to explain why for each of these. First and foremost, I want to be able to recognize the brokerage's name so that I can be confident it is legitimate and trustworthy. Second, free stock trades are a fairly recent phenomenon. I used to have to pay more than $10 to purchase or sell a stock. Today, most brokerages will do it for you for free. Third, only a few brokerages offer the possibility to buy fractional shares directly. You're presumably thinking of a fractional share. Let us imagine if you only have $90 to invest and wanted to buy $180 per share Microsoft stock. If your brokerage doesn't allow you to acquire fractional shares of Microsoft, you won't be able to do so until you have enough money to buy a complete share. If your brokerages allow fractional shares, you could buy half a share of Microsoft, a tenth of a share of Microsoft, or whatever you like. Fractional shares allow you to buy a fraction of a full share, which is convenient but not necessary. You can always save money till you have enough to purchase complete shares. Fourth, DRIP capabilities are something I'd want to see. The acronym DRIP refers to a dividend reinvestment plan. This is a simple toggle you can set for each of your dividend-paying stocks to signal that you've chosen to acquire more fractional shares of stock when your cash dividend is paid. Even if they don't allow you to acquire fractional shares directly, companies with DRIP capability can usually buy fractional shares for you. DRIPs appeal to me because they put your investing on autopilot and allow the magic of compounding to happen without you having to do anything. It's just like watching a snowball expand. When you initially start investing in dividends, you will see small gains at first, but as time goes on, you will find that you're gaining more and more money. Imagine having 1,000 shares instead of 100, and now you're getting 10 times as much. With that in mind, it is crucial to remember that if you maintain your stocks in a standard taxable brokerage account, you'll be taxed on some of the dividends you receive, even if you DRIP them and never touch the money. Which takes us on the fifth item on our list, retirement accounts. Retirement brokerage accounts like standard IRAs and Roth IRA rates allow you to buy and sell stock without paying taxes on them until you retire and withdraw the money. Each includes annual limits on how much you can put into your retirement account, as well as certain rules and restrictions on how you can withdraw and utilize your funds. To avoid the majority of penalties, you should wait until you're approaching 60 to start taking from your retirement savings. Normal taxable brokerage accounts are convenient because you can deposit as much as you want, purchase, sell, and withdraw whenever you want. But you must deal with tax implications from activities such as dividends and stock sales. There are also several types of dividends, such as qualified and non-qualified dividends, among others. I won't go into all of the tax implications, but be aware that there are some subtle tax ramifications based on a variety of things. 6th, my broker should preferably support custodial IRA accounts. These are unique brokerage accounts that you open for a juvenile or a youngster. We can invest in their account on their behalf until they are old enough to take it over themselves, which is normally at the age of 18 or 21, depending on state legislation. This is a good way to get their retirement nest account started and compounding, as well as perhaps persuade them to keep investing. Custodial accounts have some drawbacks, including the possibility of reducing a child's financial assistance eligibility while applying for college. Custodial accounts are not available at all brokerages, so like with anything, do your homework. 7. I'd like my brokers to provide a nice mobile app for seeing my account and trading stocks, as well as a solid desktop browser version. Having said that, I use a computer for 99% of my purchases and sales. 8. I'm looking for a brokerage that hasn't had a problem in the past. Some newer brokerages have recently discovered software vulnerabilities that have caused a slew of problems. Although none of these difficulties have been bad enough for me to refuse to use those brokerages, it is something to think about. 9th, I'd like to have good human customer service. There are instances when I will call and ask a query and I want a positive response. I'm not looking for a merely written document on the internet. I would want to speak to a real person. 10th, I value security. Thus, features like a multi-factor authentication are crucial to me in order to protect my accounts. 11th, I want trades that are completed quickly and at the greatest possible price. Some brokerages such as TD Ameritrade have trade windows where they buy and sell stocks for their default accounts. A trade window is the period of time during which a broker executes all deals for user accounts on a given weekday. This is done in order to keep their management fees low. That should be fine for me in general. I also want to buy the stock at the best price, and brokerages can use market makers who charge brokers a small fee for utilizing them to trade, which may or may not be the best price at that time. This is something to think about even if it won't have a big impact on you. With that said, if I were starting today with a smaller portfolio to invest, I'd definitely go with M1 Broker, despite the fact that it doesn't yet offer custodial accounts and trading windows. And if I had a larger portfolio, say $200,000, I'd probably go with a more established broker like E-Trade. So assuming I've decided to go with M1, what's the next step in getting my dividend portfolio up and running? You will have to answer some basic questions when you make an account, and then you'll connect your bank account to M1, as you can move money into your account to buy stocks, and you will decide what type of accounts you want. I would open a Roth IRA retirement brokerage account and a taxable brokerage account if I were starting now and have met all of the requirements. I'll aim to push as much money into my Roth IRA as I can, and then I'll look to put any money I have left into my new taxable brokerage account after that. So, if I were starting from scratch, what stocks would I invest in? Statistically speaking, rather than picking individual stocks and investing in them regardless of market conditions, we would be better investing in VTI or VOOs. ETFs or exchange-traded funds are VTI and VOO. These investment funds, like single equities, are traded on stock exchanges. ETFs invest in equities, commodities, and bonds, among other things. ETFs, in my mind, are stock baskets that you pay a small fee to invest in and are made up of a large number of firms. VTI owns small, medium, and large businesses in the United States, while VOOs own just large businesses. So just like you can buy Apple stock through your brokerage account, you can also buy VTI or Vanguard Total Stock Market ETFs or VOO Vanguard Total Stock Market ETF using your brokerage account, Vanguard S&P 500 ETF. Vanguard is a financial firm formed by Jack Bogle, a proponent of low-cost investment for everyday people like you and me. Investing in Vanguard funds is a straightforward and fantastic method to get started in investing. What's the next thing to think about? I'd like a diversified portfolio to distribute some risk. I would not want to lose everything if one of my single stocks goes down, so I picked stocks to build a wide portfolio of firms that spanned a variety of sectors, had a history of raising their dividends, and I believed in their growth potential, among other things. Another consideration is whether you want to invest in a lump sum or on a dollar cost average basis. Lump sum investing has traditionally outperformed dollar cost averaging, but since most people don't have huge sums to invest, let's assume you'll be putting money into your account gradually. The second question I would like to ask myself is if I want to buy Inequities at current prices or wait for a price drop. Generally speaking, purchasing on pullback yields the best returns, but some strong stocks can continue to trend up, so keep that in mind. I would definitely avoid buying at all-time highs unless I had a long time horizon and I really wanted to get into particular high-quality firms, but didn't have the patience to wait and could withstand them declining. And with that, today's video comes to a close. To express your love and support for this video, click the like button below if you haven't already. Also, subscribe to the channel by clicking the subscribe button below. And to be the first to know when a new video is posted, turn on the notification bell next to it. Thanks for taking the time to watch, and we hope you learned something. We look forward to seeing you again soon.